Today, I'm going to walk you through the entire process of buying a home in the Greater Toronto Area from zero, which is I don't even know what a mortgage is, to keys in hand, welcome home. Maybe you've been renting, maybe you're watching some of your friends buy real estate in this market and you're thinking, I missed the window. You haven't. Here's what the GTA market looks like right now in February 2026. Sales are down 19% year over year, so that means from the year prior. Prices are down 6 to 8%. And the average condo in the GTA, which is most likely your entry point if you've never purchased real estate before, is sitting on the market for 2 months before it sells. And sellers are accepting 97 cents on the dollar. And what I mean by that is the sales to list price ratio. And the last few months have shown us that conditions are back in the market and they're here for you to make the most of. You can ask for financing conditions. You can ask for inspection conditions. You can ask for lawyers to review your status certificate. And hang on, if you don't know what I mean, we're going to get to that in this video. We're going to go over all of the terms. But basically, you're asking for time to think. And this is not the GTA market that most people really talk about. We're covering every definition that you need in plain English, every government program that puts money back in your pocket, the mortgage process from pre-approval to closing day. And at the end, I've even built this GTA first-time homebuyer cheat sheet that you can download and just quickly reference when you're out shopping. If we've never met before and it's your first time here, my name is Varsha and I am a professional realtor who assists buyers and sellers in the Greater Toronto Area as well as West GTA. So we're talking Guelph, Kitchener-Waterloo. First things first, if you've never bought property before, we're gonna need to teach you some of the real estate lingo. Simply put, real estate has a certain vocabulary, and if you miss it or you don't understand it, you could very well miss opportunity. And ultimately, that could cost you money. I'm gonna go over these terms one by one. So get a beverage, get a notebook. This is going to be the most comprehensive first-time homebuyer guide for 2026 that has ever existed in Ontario. First off, the money terms. What is down payment? Simply put, it's the cash that you contribute towards the purchase of your home. Everything else is borrowed. In Ontario, as a first-time homebuyer, the minimum is 5% for the first $500,000 of your purchase price. And for homes between $500K to $1.5 million, it's 5% on the first $500K and then 10% on the remainder. Next, mortgage, the loan from your lender to cover the rest of your purchase price after your down payment. Your mortgage is paid back over time, and that period of time is called your amortization period with interest. As a first-time homebuyer, you can now amortize over 30 years as of 2024. Now, that is an option that is not for everyone, and I certainly wouldn't push it. You'll want to talk to your lender about that. Principal is the actual amount that you've borrowed, not including interest. It is just the loan itself. As you make mortgage payments, you chip away at the principal, and this is how you build equity. Amortization, how long it takes to fully pay off your mortgage. So the standard has been 25 years. However, as of December 2024, they did bring in the 30-year amortization for first-time home buyers, which can reduce your monthly costs. Mortgage term, this is the length of your agreement with your lender, which is typically 5 years. This is different from your amortization period. A lot of people get this confused, okay? But your mortgage term is your current agreement with your lender, and at the end of that term, you renew at new rates, at new terms, with your current or a different lender. Interest rate. This is what your lender charges you to borrow the money. It's expressed as an annual percentage. So say for instance, at 3.8% of a $500,000 mortgage, means you pay roughly $19,000 a year in interest for year one. And then that gets broken down into monthly payments as well. Fixed rate. Your rate is locked for that entire mortgage term. So that means predictable payments, no surprise fluctuations, and it's best for buyers that want certainty. Variable rate. Now, this rate moves with the Bank of Canada's prime rate. So this can go up and down during your mortgage term. Historically, this can save money over the long run. However, it carries an element of risk that not everyone is able to stomach. Stress test. So the federal government requires you to qualify at a higher rate than your actual rate. It's usually plus 2%. This is to prove that you can handle any rate increases. It's padding for the lender. Pre-approval. This is a formal commitment from the lender saying that they will lend you the funds at a specific rate for a specific period of time, up to a specific amount, and it's usually for 90 to 120 days. It's not a guarantee, but it does help you shop with confidence and shows the seller that you're serious about making a purchase. GDS ratio, your gross debt service. The percentage of your gross income that goes towards your housing costs. So mortgage, principal and interest, property tax, utilities. The maximum allowed is 39% and lenders will calculate this for you. Now, your TDS, total debt service. These are all your debt payments as a percentage of your GDS, your gross debt service, plus say you have car loans, credit cards, or student loans. The maximum allowed there is 44%. And high existing debt reduces the amount that you can qualify for with a mortgage. Whew. Moving on to mortgage terms. Okay, quick, take a sip of your beverage. We made it through. We're moving on to mortgage insurance terms, and this is important. The CMHC insurance. CMHC stands for Canada Mortgage and Housing Corporation, and it's a mandatory government-backed mortgage insurance for any down payment that's less than 20%. It protects the lender, not you, if you default. And the cost is added to your mortgage. A high ratio mortgage, a mortgage where you put down less than 20%, is called a high ratio mortgage. And despite the extra cost, insured mortgages actually get preferred interest rates overall. A conventional mortgage, this is down payments 20% and above. There's no mandatory mortgage insurance. This is a higher down payment, but there's no insurance premium that's added to your mortgage. LTV, loan to value, the ratio of your mortgage to a home's value. If you put 5% down, then that's 95% LTV. You put 20% down, that's 80% LTV. The lower the LTV, that's less risk for the lender, and therefore you get better rates. Moving on, property terms. Freehold. You own the land and the building. You're in full control. There's no monthly condo fees. This includes detached, semi-detached townhomes. And you're responsible for all of the maintenance. A condominium. This is where you own your unit. However, you share ownership of common areas with other unit owners, and a condo corporation manages the building. So you pay monthly maintenance fees. These generally cover your building insurance, the area upkeep, maybe some repairs and maintenance, and they also include your reserve fund contributions. And they're usually calculated on a per square foot calculation that really needs to be factored into your affordability calculations. Status certificate. Now, this is a lengthy document, and that tells you the financial and legal health of the condo corporation. And this is required before you purchase a condo, and is strongly encouraged that you have a lawyer review this before you firm up on an offer if you're purchasing a condo. It reveals the status of the reserve fund, any ongoing lawsuits, special assessments, or any other financial pain points. Reserve fund. And I know you're going to ask, okay, what is a reserve fund? This is, for all intensive purposes, the condo savings account. They take out of it for major repairs, whether it's the roof, whether it's the elevator, whether it's the parking garage. I've seen condos where high-tech plumbing had to be redone. A healthy reserve fund means there's no special assessments. That's charged to the owners of the unit. And obviously, what is a special assessment? It's basically a bill that's sent to all the condo unit owners, and it's when the reserve fund cannot cover the repairs that need to be done. It can be thousands of dollars, and it can be due quickly. I've Unfortunately, had clients in this exact position last year who were trying to offload a condo. So you need to be sure about the reserve fund and the strength of a condo corp if you're looking to purchase one. Finally, we have some transaction terms. And these are just a few that are top of mind and by no means a comprehensive list, but number one is your agreement of purchase and sale. This is a legal contract between the buyer and the seller. It specifies purchase price, deposit, closing date, the irrevocable, any included items, chattels, your closing date. Once it's signed and no conditions remain outstanding, it becomes legal and binding. Your deposit, and a lot of times it's easy to get confused with deposit and down payment. Although both funds go towards your ultimate purchase price, your deposit is cash that's paid when your offer is accepted. And it is held in trust by the listing brokerage until closing. It's typically 5% of your purchase price. It is, again, not the same as your down payment, but it is part of. What are conditions? They're clauses in your offer that need to be completed before the deal can firm up. So the most common ones are financing, making sure that you qualify for a mortgage, a home inspection condition where you have a qualified home inspector that's gone through the property, you get a report, and you're comfortable with proceeding with the purchase of the property. And then, once complete, you waive those conditions and then the deal becomes firm. Speaking of firm, what is a firm offer? It's an offer without any conditions, or an offer where conditions have been satisfied. Once both parties sign the APS and it has gone firm, you are legally obligated to buy the property. Closing date. This is the day the legal ownership of the property transfers to you, the buyer. Your lawyer completes all of the financial transfers, registers the title in your name, and you receive the keys. Closing costs are also paid on this day. Title insurance protects you against any defects in title if there's fraud, if there's survey errors, if there's unknown liens on the property. It's pretty much required by virtually all lenders, and it's a one-time cost at closing. And finally, your land transfer tax. As a buyer, you will need to factor in this cost. It is a provincial tax that is paid by every buyer in the province of Ontario. First-time home buyers get a rebate of up to $4,000, but if you're purchasing in the City of Toronto, you actually pay a municipal, so a second land transfer tax. And so you're essentially doubling your land transfer tax, but there's also additional rebates for that. We have made it through the glossary of terms, and do not worry, I will definitely include some sort of link for you to download. Now, here is something most people don't realize. If you're a first-time home buyer and you're looking to purchase property in Ontario, the government puts money back in your pocket through certain government-backed programs. Not everybody knows about them and almost nobody uses them altogether. And here I'm going to give you the full breakdown. First is the First Home Savings Account, or the FHSA. It's a registered account combining your RRSPs and your TFSAs, and it is purpose-built only for first-time home buyers. Okay, your annual contribution is $8,000 and your lifetime contribution is $40,000. It is deductible like an RRSP, so it reduces your taxable income. And it's tax-free like a TFSA, so money in grows. And when you withdraw from it, you are not taxed on the amount withdrawn. Say there's two of you that are buying your property for the first time. Both of you can each operate and have your own FHSA accounts with full limits of $40,000, your lifetime limits. So you do have to be a Canadian resident of 18 plus years in order to qualify. Even if you have no short-term goals of buying property, open it up, because the contribution room accumulates over the years, but only from the year that you open. Next, something that's definitely seen a lot of attention is your home buyer's plan. So this lets you borrow right from your RRSPs for the purpose of purchasing your first home. And it's tax-free. Your individual withdrawal limit is $60,000. And if you're, again, buying as two of you, the limit is $120,000. And it's not taxed so long as you pay it over a 15-year period. And the payments start year 2 after withdrawal. And here's the thing, you can combine your RRSP as well as your FHSA for the purpose of your down payment for your first home. They're stackable. Just to dream a little bit, if there's two of you that's coming together to purchase a property and say you've maxed out on your FHSA as well as your RRSP contribution limit, I know what you're thinking. What world do you live in, Varsha? Just dream with me, okay? Especially if you're trying to get into the condo market right now. So if you've maxed out your FHSAs at $80,000 and you've maxed out your RRSPs at $120,000 and combined, you're bringing $200,000 to the table as your down payment. And say you're buying a condo at $700,000, that's a 28.5% down payment. There is no CMHC insurance involved. Next, something to touch on briefly is the first-time homebuyer tax credit, federal tax credit that's applied after you buy, and it's claimed on your T1 on the year that you purchase, so you're filed with your taxes, and it's $10,000 that you can claim. First-time homebuyers qualify, and it also needs to be your principal residence. The Ontario Land Transfer Tax rebate is a partial refund on the provincial land transfer tax for first-time home buyers, so that's up to $4,500. In the City of Toronto, where you have an the MLTT, the Municipal Land Transfer Tax, that rebate is a max of $4,400. And both of these rebates fluctuate with the purchase price of the property that you end up buying. Let's quickly touch on the mortgage process, but I'm going to urge you to talk to a mortgage broker. If you need a trusted broker, you can of course reach out. I have a list that you can select from. However, when it comes to the mortgage process, I find gathering documents is clients' biggest pain point. Most people think it's just one step. You go to the bank and you've got a mortgage. It's actually a sequence of steps. And one of the number one things you need to figure out is if you're going to go to your bank or if you're going to go to a mortgage broker. I lean towards the side of a mortgage broker, but that's because I like options. I like access. And most of my clients that I know and work with actually fall into both categories. I've seen some just be so committed to their bank and some that are open because they want variety. They want other options. The bank is only going to sell you their one product versus a mortgage broker that has access to many different lenders, and with those come many different mortgage products. Once you've made the decision, bank, mortgage broker, the next step is gathering your documents, and do it swiftly, do it quickly. You'll need 2 of your most recent pay stubs, your notice of assessments, letter of employment confirming your work, 3 months of bank statements, government issued IDs, proof of your down payment source, and this could include gifted funds. And if it does, you'll need a gift letter from your family and a record of any existing debts. So car loans, student loans, credit card payments, things like that. Step 3 is your pre-approval, a conditional commitment from your lender, saying they will lend you X amount at Y rate for a period of 90 to 120 days. It's not the guarantee of a final approval. However, it does give you some confidence when you are out house shopping. So it also protects your rate, so a rate hold in a sense. So when you're out house shopping or you're in the process of buying a home actively and rates fluctuate at that point, this pre-approval kind of locks in that rate for you. If you get anything from this video, please get your pre-approval before you start walking through properties. Finally, your final approval. And this is property specific. Once you have an accepted offer on a property, your lender needs to approve the property itself, not just you as the borrower. They will order an appraisal. If a home appraises at or above the purchase price, you're typically okay. Difficulty arises when it appraises below. Your lender will only lend against that appraised amount. So it'll be up to you to make up that difference. And that is called an appraisal gap. So where can you actually buy? With all of this knowledge that we've accumulated in the course of this video, we've got the terms, we've got the ins and outs of the mortgage process and how you need to be prepared. Let's go in, let's zoom in a little bit and figure out where can you actually buy as a first-time home buyer in today's GTA climate. The condo inventory in the GTA is at 5.83 months of supply, and that's a buyer's market territory. So what that means practically is if you as a buyer are shopping for a condo, it's the sellers that are competing with each other. It's not the buyers over the property. Sellers are trying to stand out and garner your attention. This is power in today's market. You can ask for conditions. You can ask for terms that closing that aligns for you. But I also need to say, this is the art of a good negotiation. That's what happens in a market like today. As much as this is a first time for you in purchasing a property, if you've never had a negotiation, if you've never been involved in a negotiation, it's how does everybody feel that they've won? How are all interests upheld is also an important thing to keep in mind. And please remember, not all condos are built the same, quite literally, from the way that they're built, their condo fees, whether it's low cost maintenance, the location, of course, healthy reserve fund, and good management. Those tend to age well and also resell well. Which brings me to our buying process. We've made it here, and this is probably my favorite part of this because it involves an artful negotiation. It involves carrying a client through the entire process with such clarity and care till their ultimate reward of a home. Such a beautiful timestamp in their journey. Here is the actual sequence of events when it comes to buying a home in Ontario. I'd encourage you to interview buyer's agents. Okay, buyer's agents are there to represent you in a negotiation because yes, there's legal minutia involved and contracts, but also it's important to make sure you're making the best use of your time. So I would encourage you to make sure you're interviewing agents that are in this on a full-time basis and also know what your future resale looks like for the properties that you end up streamlining. Next comes narrowing your search. You're going to define your geography, define your property type, and any deal breakers. Start attending open houses. Depending on what you offer on, if it's a freehold property versus a condo, there's a different structure and there's a different offer that's made and different parameters for due diligence. Whether you need a status certificate with a condominium or whether you need a home inspection done for a freehold. Structure your offer in conjunction with your agent and really make sure that you understand the elements of the agreement of purchase and sale and all of the contracts that you'll be signing. Finally, once you have an accepted offer, a firm and binding offer, congratulations, you've purchased your first property. Really quickly, I want to talk to you about something that doesn't show up in spreadsheets, and that's fear. The fear that you're paying too much. The fear that prices will drop right after you buy. The fear that you'll find out something's wrong with the property after you've purchased it. The fear that you'll get approved for a mortgage and then lose your job. The fear that everyone else seems to understand this process, but you don't, okay? All of those feelings are normal. See, of that list, I'd say the most prominent one is, what if prices fall further? In conversation with clients, that is the one that keeps coming up. It's the most common fear. Real estate prices in the GTA have fallen before. They have fallen as recent as 2022, 2023, and now they're down again. And they also recover without exception. See, in the next 5 to 7 years, the GTA population is going to be higher. It's going to be larger, and housing supply will be constrained at that point. And you'll have been quietly building equity for that 5 to 7 year period. So if you qualify in all of these regards that we've discussed in this video, the math of waiting is almost worse than the math of you investing and purchasing in this market. The market is softer than it has been for recent years. Rates are lower than they were 18 months ago. You have access to programs, the FHSA, the Home Buyers Plan, the LTT rebate. That genuinely changes the math. And now you know the process from beginning to end as well, and some key terms to keep the confusion at bay. See, buying your home in the GTA is not easy, and no one is pretending that it is. But it is absolutely possible. And buyers who look back in 10 years feel great, absolutely great about the decision to have bought. So build the plan and move when the window of opportunity is right. First-time home buyer, your first step is open your FHSA account. Your second step is connect with a mortgage broker. If you need one, I've got you. And third, I'm going to keep the cheat sheet, the cheat code. It'll be in a link below. And if you're upsizing, say you already own property, this next video coming up is just for you.